Chapter 1 Introduction to Accounting. Learning Objective. After completing this chapter, you should be able to define what is accounting, distinguish between different forms of business organization, differentiate between accounting and bookkeeping, elaborate the scope of accounting, identify the uses of accounting information, and explain the accounting process. In the business world, accounting is regarded as the language of business. Accounting plays a major role in the recording and communication of business events. It is also an essential tool in measuring business performance and providing management with important information so that the appropriate decision can be made for the benefits of the business entity. Accounting can be defined as a systematic process of identifying, recording, measuring, classifying, verifying, summarizing, interpreting, and communicating financial information to the users for decision-making purposes. Forms of business organizations. As mentioned earlier, accounting records the financial transaction of a business. A business can take one of 5 main forms of organization, and in some cases, the accounting procedures depend on which form the organization takes. The 5 types of business organizations are as follows. First is the sole proprietorship. Second, partnership. Third, company. Fourth, limited liability partnership or LLP. And last one is cooperative. Sole proprietorship. A business owned by only one person. This business is easy to set up and is the least costly among all forms of ownership. Sole proprietorship governed under the Registration of Businesses Act 1956 and Rules 1957. The owner has unlimited liability, which means that in the case of the owner of the business is unable to pay their creditor, the creditor can go after the personal assets of the owner to recover the amount of debt. Partnership. A business owned by 2 or more people but not exceeding 20 people. This partnership is governed under Partnership Act 1961. The partners share the profits and bear the risk of the business among themselves. In general partnerships, all partners have unlimited liability, which is similar with sole proprietorship, where the creditor can go after the personal assets of the partners in the event of financial default. Company. A business organization that has a separate legal personality from its owners. The company incorporated and governed under the Companies Act 2016. The ownership in the company is represented by the number of shares. The owners are known as shareholders, and company must have at least 2 shareholders. Normally, shareholders have limited involvement in the company's operations, where they would vote and elect a group of shareholders or any third party as members of the board of directors. The board of directors is headed by the chairman, which manages and controls the business activities. The shareholders enjoy limited liability on the amount invested in the company. Limited Liability Partnership, LLP. A hybrid form of business that has characteristics of both a company and a partnership regulated under the Limited Liability Partnerships Act 2012. LLP combines the characteristics of a company and a conventional partnership commonly used by professionals such as lawyers, chartered accountants, and company secretaries, small and medium business, and joint venture. Amongst others, LLP is featured with the protection of limited liability to its partners, similar to the limited liability enjoyed by shareholders of a company. The last form of business organizations is cooperative. Cooperative is a business owned by a group of individuals and is operated for their mutual benefit. The person who contributes to the capital is called a member and has a voting right irrespective of the amount of capital contributed. All cooperative organizations must be registered with Suruhanjaya Koperasi Malaysia and governed under the Cooperative Act 1993, amended 2007. Examples of popular cooperative organizations in Malaysia are Koperasi Bank Rakyat and Co-op Bank, Persatuan Malaysia Berhad. Every year, the members will appoint their representative on the board to run the cooperative. Bookkeeping versus accounting. Many people mistakenly assume that bookkeeping and accounting mean the same thing. This confusion is understandable as the accounting process does include the bookkeeping function. Bookkeeping refers to recording all transactions on a day-to-day basis, such as recording of financial transactions, example, payments to suppliers, loan payments, and recording sales and expenses, posting debits and credits, producing documents, example invoices, and maintaining subsidiaries and general ledgers. Bookkeeping is more transactional, concerned with recording financial transactions, and ensures records for each transaction are correct, up to date, and comprehensive. Accounting, on the other hand, is a high-level process that uses financial information prepared by the bookkeeper to produce various reports and documentation for decision-making. Hence, the process of accounting is more subjective than bookkeeping. Accounting turns the information from the ledger into statements that reveal the bigger picture of the business and the path the company is progressing on. Business owners will often look to accountants for help with financial planning, tax planning, and tax filing. Among the accounting activities involved, in addition to bookkeeping, are preparing the adjusting entries, preparing financial statements, analyzing costs of operations, completing income tax returns, and advising the management in evaluating the impact of financial decisions. Accounting information. Financial statements, as the principal source of information, summarize the results of operations and the financial position of the business. Four main statements that are commonly prepared by publicly traded companies are as follows. First, statement of profit or loss. This statement reports the profitability of a business during a specific accounting period, such as a month, a quarter, or a year. This statement is essential for users to compare results for the business over similar periods of time or with their competitors. And this statement presents all revenues and expenses, which are then meshed to calculate the net income, profit or loss. A business profit or loss is the main interest of financial statements users. Number 2 is statement of financial position, formerly known as balance sheet. This statement reports on the business financial position, specifically the business assets, liabilities, and equity. Next is statement of cash flows. This statement summarizes the amount of inflow and outflow of cash and cash equivalents. Main components are cash from operating activities, cash from investing activities, and cash from financing activities. This statement of cash flows indicates how well a business managed its cash position, specifically how well the business generates cash to pay its debt obligations and fund its operating expenses. The last statement is statement of changes in equity. This statement presents the change in owner's equity over an accounting period by presenting the movement in reserves comprising the shareholders' equity. In this statement, there are several elements such as net profit or loss during the accounting period, increase or decrease in share capital reserves, dividend payments to shareholders, gains and losses recognized directly in equity and others. The statement helps users of financial statement to identify the factors that cause a change in the owner's equity over the accounting period.